we need to know what a gap is in the first place. So a gap is going to be caused by a significant move in extended hours trading, whether that be after hours or pre-market, usually due to some kind of news catalyst. And some very common news catalysts that can be released, often causing stocks to gap in either direction, whether it be up or down, are earnings reports, trial results, a company buyout, a new patent that the company has for one of their products, and so on and so forth. So something like this is going to be released 9 times out of 10 in after hours or in pre-market trading. They're usually not going to do it within the middle of the day while the market is open. And because of that, that usually causes a stock to make a significant move again in extended hours trading. And because the extended hours is not shown on your daily chart, when the stock opens the next day, that's going to leave a big gap in either direction on the daily chart. Now, one of the ways to trade these is, of course, to look for an opportunity to buy into a stock that's gapping up and look for a momentum trade. But the way that I personally like to trade it is by looking for an opportunity to short sell. So for those of you who do not know what short selling is, it is a trade type that actually allows you to profit from a stock going down rather than up. So you still want to buy low and sell high just like you would with any other investment. The difference though when you're short selling is that you want to simply sell high first. And the way this works is when you place an order to short sell, that's going to request to borrow shares from your brokerage of that stock, and then you can sell it at ideally a higher price. Hopefully from there the stock price will go down and you can buy back those same shares, return them to your broker, and either profit or lose the difference between where you sold and where you bought. And the reason that I prefer to short sell these stocks that are gapping up is because, again, I'm focusing mostly on penny stocks or small cap stocks. And a majority of the time, penny stocks are going to be very weak stocks in the long run. So if you look at the longer term charts of a small cap stock, you can see that just about every single time they spike up or every single time they have a big gap up due to some kind of news being released, they usually end up giving back all of those gains and coming all the way back down to reality, because at the end of the day, the news that's being released isn't enough to change the overall company itself. So the company is still going to be very weak in the long run. And because of that, the stock is going to be weak in the long run as well. So when it's gapping up like that, it usually offers us a great opportunity to short sell at higher prices before the stock comes back down to reality. Okay, so when trading penny stocks that are gapping up, generally you're going to have a much higher chance of profitability from short selling rather than buying. And that's, at least in my experience, the way that I personally like to trade. Now, I'm not saying that you can't make money, of course, from buying stocks, but at the end of the day, the data simply supports the fact that penny stocks generally come back down after they have a strong move up. Okay, so the way that we look to short sell these stocks is you can't just find stocks that are gapping up and short sell them at any price and hope for them to come back down in order for you to profit. You want to look for something on the chart, some kind of technical analysis to give you an idea of where you should actually enter into that short position. And one very simple way to do this, and this is actually probably going to sound a little bit too simple for it to actually be true and for it to actually work, but I promise you, I've made thousands and thousands of dollars with this very simple strategy. And I actually know many other professional traders that use just this one strategy alone to trade stocks full time. And what that is we're going to look for a level of resistance on the chart to short sell into when these stocks are gapping up. So first and foremost, just to give you an idea of what resistance is, if you're brand new to the market, resistance is going to be a price level where historically a stock has a difficult time breaking above. This is caused by a greater amount of supply than demand, and because we know the market is run solely by buyers and sellers, your buyers, of course, being the demand, and your sellers being the supply, when there's a greater amount of sellers or supply at a level of resistance than there is buyers or demand, that's going to cause the stock to fall from that price. So we can actually look for these resistance levels on our charts and use them as a great opportunity to enter into our short positions and profit from the stock going down from there. So to summarize, this very simple strategy is to look for stocks gapping up in pre-market. Again, ideally in the $1 to $10, even up to $15 range per share. Then you're going to want to at least make sure that you check out the news, because if it is a very strong catalyst and a very strong piece of news, then you know that the stock may be stronger throughout the day, and you may be a little bit more cautious to short sell the stock. After that, you want to go onto your daily chart and you want to look for previous spikes or previous gaps up on the chart and use those days to draw resistance lines on your chart. And then you're going to use those same resistance lines on the daily chart for your entries on your short position when you're looking at the stock on your intraday time frame. So if you're looking at the 1 minute, the 2 minute, the 3 minute, 5 minute, and so on and so forth, you're going to see the stock move into those same resistance lines and you're going to look for weakness at them as an opportunity to short sell. So just to give you an example of this, if we look at the chart here on the top, you can see that's the daily chart, and then down on the bottom is the same stock, but the 1 minute chart. Now, if I go ahead and exit out here so I can point out to you what I'm talking about, you can see that on this day, the stock spiked up a little bit, just to about 115, a little bit below. And then a few weeks later, the stock again spiked up right about to the same level, this time to about $1.12. And that's going to cause a level of resistance. So you can draw that line there and use it as a potential opportunity to short in the future when the stock spikes up into that level. Okay, if we draw another one, you can see that right about here, the stock goes to about $1 per share, again right here, and again right here. So that's going to be another potential level of resistance. Now, if we look at the 1 minute chart at the bottom, you can see that on this particular day, which is this candle here on the daily chart, the stock is actually gapping up above that $1 resistance. So in this case, this is not going to be a potential level to short into because the stock is already over that resistance level when the market is opening. So in this case, we would look for the 112 to 113 area to short into the next level of resistance. And as you can see right here at the market open, the stock actually spikes up and hits perfectly into that resistance at about 113 before it fades all the way back down into the 80s. So on this one trade alone, there was potential to make